In 2008, a single line of computer code set off a domino effect that almost crashed the entire global economy. Sounds wild, right? But this isn't just a story about numbers on a screen. It's about how technology, human ambition, and a bit of overconfidence collided to create one of the most dramatic financial disasters in history. But let's rewind and break it down. To really understand what happened, we need to go back to a time when banking was a lot simpler. Banks used to make money the old-fashioned way: loans, mortgages, keeping your cash safe. They were seen as pillars of stability, places where your money would be protected for generations. But when Wall Street realized they could bundle thousands of mortgages together and sell them as complex securities, they needed fast, precise code to handle the billions at play. Suddenly, banking wasn't just about vaults and ledgers, it was about algorithms, data, and speed. Enter the quants, math wizards who wrote algorithms to price risk, buy and sell at lightning speed, and of course, make big profits. These were the new rock stars of finance, using advanced math and computer science to outsmart the market. The problem? Most of these codes assumed the market was always rational and prices would move in predictable ways. The models were built on neat equations, but real life is messy. But they missed one crucial detail. Humans aren't predictable, and neither are markets. Emotions, rumors, and panic can change everything in an instant. Mortgage-backed securities became the hottest game in town. Everyone wanted a piece, from big banks to small investors, and the demand seemed endless. Banks kept issuing loans, even to people who couldn't afford them, just to feed the machine. The more loans, the more securities, the more money, at least on paper. The code said everything was safe. But behind the scenes, the risk was piling up like dry tinder. The system looked stable, but it was actually a house of cards, ready to collapse at the slightest shake. When homeowners started defaulting in droves, the models broke down. Suddenly, the assumptions that had kept the system running no longer held true. The algorithms, programmed to manage normal ups and downs, never anticipated a total collapse. The dominoes started to fall, and there was no stopping them. Suddenly, banks couldn't trust each other, credit froze, and the crisis went global in days. What started as a technical glitch became a worldwide panic. It's easy to blame the code, but really, it was a perfect storm of overconfidence, greed, and blind faith in technology. People believed the numbers more than their own instincts and ignored warning signs until it was too late. The lesson? Even the smartest code is only as good as the humans who write it, and the sanity checks we build in. Technology is powerful, but it needs oversight, skepticism, and a healthy dose of humility. So next time you hear about AI running our financial system, remember, it only takes a few lines of code to shake the world. The next big crisis could be just a bug, a bad assumption, or a missed warning away. If you want more stories that decode the world of finance, hit subscribe and stick around for the next one. There's always more to uncover beneath the surface.